Welcome to the Ideal Investor Show. Challenge your mindset and discover where you are. Let's go. Hello and welcome to another episode of the Ideal Investor Show. And today I want to talk to you a little bit about asset allocation and what it really means and how it actually shifts. And you probably know, if you're a regular listener and viewer of our show, that I have this kind of split, if you look at it basically like a pizza pie, on how are the individual pieces split up. But there are movements within those. So if we just start with the regular split, I always say we would like to have 65% in residential real estate, 10% in stock, 10% in gold, silver, diamonds, and 10% in cash. And that leaves 5% for Bitcoin. And I mean it really deliberately like that. I don't really consider any of the other cryptos worth really looking at. Okay, so that's the fundamental distribution. Now, I just mentioned Bitcoin, and it's a really good example because when it comes to allocation, you would actually go ahead and say, okay, if I had $10,000, or let's say $100,000 is a little bit more realistic, we can use $65,000 to buy real estate, which would probably in this day and age give us about two properties, two small single-family homes that we could buy with 80% financing and have them rented, and that would be the one asset. And then the other ones are basically 10,000 or 5,000 that we spend on these other assets, as I just described before. And that is kind of like the starting point. Now, different things are important when it comes to asset allocation because, as you know, these assets are not stagnant, right? So, for example, your property, your real estate property, will increase in value year after year. And when you say increase in value, you have a number that is associated with it, but then you also have basically value in the sense of how much money you can make from rent and so forth. What do I mean when I say a number? So if we go ahead and say, okay, I bought this house, and we said we use half of our $65,000, so something like about $32,000. So let's say we bought a $150,000 house. And that $150,000 house has been in our portfolio for a few years, and now it's worth $200,000. Now, if all the other assets have increased by about the same amount, so from 150,000, that would be 50,000 more. So that's basically, let's see, 30, about 30% increase in value. Well, that's true if you look at it in US dollars. If, on the other hand, you were to look at it in different currencies, for example, in euros, then just in this year, 2025, we went from the euro and the dollar being almost the same, right? So it was basically $100,000 and 100,000 euros was almost virtually the same. And at the time while I'm recording here in July of 2025, that ratio is now almost 20% change. So right now, you get, if you have 120, if you have 100,000 euros, that's $120,000. Or the other way, if we say, okay, in dollars, our house is worth 200,000 now. In euros, it's only worth 160,000. Why is this relevant? Because you cannot just look at the asset in one currency. The same thing is true. You will probably have seen or are seeing, depending on when you're actually listening or watching this episode, you will hear that Bitcoin reached a new all-time high of almost $120,000. But because of this currency difference, in Europe, if you look at it in euros, it's still below 100,000. So for the Europeans, when they read articles and they say Bitcoin reaching 120,000, well, they always have to ask themselves, how is that possible? Because in our portfolio, when we look into our wallet or into our account, it's not even 100,000. Well, so the asset allocation is relevant in the context of the currency that you're using. If you do everything in US dollars, you're buying, you're selling in dollars, you're living in dollars, you're getting paid in dollars, that really doesn't make that much of a difference. But as soon as you put in assets that have an international component, so what are those assets? One of them would be, for example, Bitcoin, because it is basically converted. The value of Bitcoin is converted into all the different currencies. So depending on where you live or which currency you're using, there's a different price. Not value, but a different price. The same thing in a way is true for gold. For almost all the different quotes you see for gold, most people don't know that that is typically for 1 kilogram of gold, not just one little coin. And then the other thing is it's almost always quoted in US dollars. So again, same thing applies, right? If we had a 1 kilogram bar of gold and the ounce price per gold is $3,500, somebody in Europe or somebody in Saudi Arabia or somebody in another country with a different currency has a totally different number in their currency to pay. So that's actually in the asset allocation what's called currency risk. And you want to kind of be aware of that. And this also comes into play when you're thinking about investing internationally, right? Because if you go and say, okay, I bought this house that we talked about earlier, one house in the US, and I used my $32,000 and got my $150,000 house in dollars somewhere in the US. And the other $32,000 I used in 2024, but I didn't buy the house in the US, I bought the house somewhere in Europe. Now that house has also increased in value, just like the one in the US, but on top of it, it has also gained almost 20% in currency value. Because when you sell that house for 200,000 euros, you would actually get $240,000 back, even though you started out with $32,000. So the currency makes a huge difference. And just to put a finer point on it, obviously this can also go in the other direction, right? If you invest internationally in a property or in an asset where the currency is falling, right? Like Europeans buying houses in the United States with euros, then yes, their properties gain value in the United States, but when they sell them and convert the money back into euros, they may not have gained anything because of the difference in the currency valuation. So those are a few things that go a little bit beyond what we normally do, and it's just looking on how much does something cost and how much do I get out of it. So what is kind of like the return of my investment? And now taking into consideration what happens when the value of the currency is changing from the time that you buy something to the time that you're actually selling it. So I hope that was educational, something that you don't typically consider and that you now will consider in the future. And I hope to talk to you again soon. So be well and stay safe.